The danger of having $1 million is not that you'll spend it. The danger is that you'll spend it on things you don't actually want because you've internalized a story about what a person with $1 million is supposed to want. The boat you'll use never. The house that's bigger than the life inside of it. For me, having money has always meant one thing above everything else: freedom. Hello friends, this is Tyler Gardner welcoming you to another episode of your Money Guide on the Side, where it is my job to simplify what seems complex, add nuance to what seems simple, and learn from and alongside some of the brightest minds in money, finance, and investing. So let's get started and get you one step closer to where you need to be. Quick note before we get into it. May's pre-order incentive for my book, Real Wealth, is now live. When you pre-order this month, I'm sending you 2 chapters that didn't make the final cut. Chapters I genuinely love and wish I could have kept, delivered digitally in early June. Pre-ordering also locks you in for every monthly incentive between now and the December 1st release. Go to tylergardner.com/book, click the button that says claim my bonuses, upload your receipt, takes 2 minutes, and you're in. Now, on with the show. I want to start by playing a mental game with you today. It's one you've probably played before, but this will be a little different, as we're going to explore it together for the next 45 minutes or so. You wake up tomorrow morning. It's a Tuesday. Nothing particularly special about it. You make your coffee, you let the dog out, you check your phone, and there it is. $1 million. Sitting in an account with your name on it. Clean. Yours. No catch, no contest, no eccentric uncle with unusually good timing. Just $1 million and a cursor blinking at you, waiting for a decision. What do you do? And I don't mean philosophically. I don't mean in a dream sequence where you buy a boat and move to the Amalfi Coast and your problems dissolve like sugar in warm water. I mean practically, specifically, right away on that Tuesday morning, what is the first thing you do with $1 million? Because here's what most people actually do. Nothing. They panic freeze. They call someone, a family member, a friend, sometimes a guy they vaguely remember from a finance class in 2003, and they say, help. And suddenly, they are on 17 different mailing lists and getting phone calls from 22-year-olds at major brokerages who want to talk about some tax inefficiencies they've identified, and before they know it, 6 months have passed, and the money is sitting in a checking account earning nothing, which for $1 million is costing them roughly $30,000 a year in lost purchasing power. $30,000 per year, just sitting there. Today, I'm going to tell you exactly what I would do. 3 things I would do immediately, 3 things I would absolutely not do, and 3 behavioral patterns I would watch for in myself, because having money does not make you immune to the specific psychological traps that money creates. It mostly just makes the traps way more expensive. This is going to be a very practical episode, and it also is not based just on $1 million. You can apply these principles to any lump sum going forward. It is going to be specific, and it is going to be considerably simpler than the financial services industry would prefer. And as always, before we get into it, if this podcast has been helpful to you in any way, if it has made you think or laugh or share it with a friend who might need the reminders, please consider leaving a review on Apple or Spotify, as it helps more people find the show, and it helps me know that I'm not just crafting 40 minutes of content each week for an audience of bloodhounds who, I should mention, have never once left a review despite being present for every single episode. Let's get into it. Section 1, 3 things I would do immediately. Number 1. Before anything else, I would put it somewhere safe and smart on day 1. Here's what I mean by that. The very first thing I would do, before I called anyone, before I made a single investment decision, before I told a single person it existed, I would move it into a high-yield savings account or a money market fund that day, that morning, before the coffee gets cold. I want to explain why this is not the boring, obvious move that it sounds like, because I think most people underestimate what this actually means at $1 million level. A traditional checking account or standard savings account at most major banks pays you somewhere between 0 and 0.01% interest. On $1 million, that's about $100 per year, which is less than what you'd make selling a moderately interesting piece of furniture on Facebook Marketplace. A high-yield savings account or money market fund right now is paying somewhere in the neighborhood of 3.5% to 4% annually, depending on the rate environment. On $1 million, even at 3%, the rough historical average, that is $30,000 per year. $30,000 in interest on money that is sitting still in a risk-free account while you figure out what to do next. I want you to repeat that to yourself. 3% on $1 million is $30,000 a year. Your $1 million parked responsibly while you make decisions earns what some people earn going to a job every day for a year. That is the entire point of having capital work for you rather than you working for capital. This is also not an emotional move. It's not an investment strategy. This is just the correct answer to the question, where does the money go immediately while I'm still thinking? And the answer is emphatically not in a checking account earning $100 a year while your purchasing power evaporates. So specifically, where would I put it? Here are a few options worth knowing. High-yield savings accounts, Marcus by Goldman Sachs, Ally Bank, and SoFi consistently rank among some of the highest yielding FDIC-insured savings accounts available. Rates will fluctuate with the federal funds rate, but these institutions typically run meaningfully above the national average. FDIC insures up to $250,000 per depositor per institution, so at $1 million, you'd want to spread across multiple institutions or account types, which is a 5-minute logistics exercise, not a problem. For money market funds, these are slightly different from money market accounts at a bank. A money market fund, like Vanguard Federal Money Market Fund, ticker VMFXX, or Fidelity Government Money Market Fund, ticker SPAXX, holds short-term government securities and has historically yielded close to the federal funds rate. They are not FDIC insured in the traditional sense, but they invest in government-backed securities and are considered among the safest investment vehicles that exist. That's Vanguard's VMFXX and Fidelity's SPAXX, and they're two of the most widely used. At the time of this recording, these were yielding somewhere in the 4% range, depending on the rate environment. Or you can stick it directly in treasury bills. If you want the absolute purest risk-free return, buying short-term T-bills directly through treasurydirect.gov gives you the full faith and credit of the United States government, with yields competitive with money market funds. 3-month or 6-month T-bills in a high-rate environment are a genuinely compelling place to park significant cash while you figure it out. The point is not which of these you choose. The point is that the difference between parking $1 million in a checking account and parking it in any of the above is potentially $30,000 to $50,000 per year in interest income. That's the price of doing nothing, and most people pay that price. Day one, money market or high yield account, before anything else. This week's episode is brought to you by Keeper. Quick admission, I have, by my best estimate, 11 billion passwords. Bank, email, brokerage, the IRS, and roughly 59 streaming services I forgot I subscribed to. None of them are as strong as they should be, because the strong version is also 11 billion characters, and my brain, which can recall the lyrics to a 1996 Hootie and the Blowfish song without effort, cannot tell you if my email password ends in a hashtag or 7 exclamation points. We're living in an era where the average adult is expected to be the security perimeter to their own digital life, and most of us are simply not up to the job. That's the problem Keeper solves. My business now relies heavily on multiple online platforms, all of which are susceptible to ding-dong scammers, so I need a solution that actually keeps things strong. Keeper is a password manager that creates strong, unique passwords for all your accounts, stores them securely in one place, and logs you in automatically across all your devices, so you never have to remember, guess, or worry about your login credentials again. And right now, Keeper is offering my listeners 60% off personal and family plans at keepersecurity.com/Tyler. This offer is only for you, our podcast listeners. That's keepersecurity.com/Tyler for 60% off personal and family plans. Make sure you use our link so they know we sent you, keepersecurity.com/Tyler. This episode is brought to you by Anthropic. 2 real moments from the last few weeks. First, I needed a 10-slide deck for the May 6th webinar. Previously, that meant I'd call a designer, get 3 rounds of revisions, and have a polite back and forth where I pretend not to have opinions about kerning. I dropped my color palette and 1 photo into Claude Max and had a finished deck in 3 minutes. Second, I write a weekly newsletter to about 200,000 people, and every day I'm tinkering with new chapter ideas for potential books. The margin for error on either project is 0. I need nuance, accuracy, and a collaborator that tells me plainly when a joke I think is hilarious simply isn't landing. Claude does this. Additionally, its research goes deeper than basic web search. It's comprehensive, reliable analysis with proper citations, turning hours of work into minutes. Claude is the AI for minds that don't stop at good enough. It's the collaborator that actually understands your entire workflow and thinks with you. Whether you're debugging code at midnight or strategizing your next business move, Claude extends your thinking to tackle the problems that matter. For problems worth solving, get started with Claude at claude.ai/Tyler. That's claude.ai/Tyler. And check out Claude Pro, which includes access to all of the features mentioned in today's episode. claude.ai/Tyler. Number 2, analyze your debt and invest according to when you need the money, not your age. Once the money was safely earning something well, I think, here is what I would do next. I would sit down by myself without anyone else involved, and I would try to honestly answer 3 questions. First, do I have any debt above 7% interest? Then, when do I need the actual money? Finally, what does my investing timeline actually look like? Let me take each of these in order. On the debt question, if I had any debt carrying an interest rate above 7%, I would pay it off immediately. No complicated analysis, just gone. Here's the logic stated as simply as I can put it. The long-term average real return of the S&P 500 post-inflation is roughly 7% annually. So that's your benchmark. That's what you're trying to beat by investing rather than paying off debt. So if your debt costs you more than 7%, credit cards typically running 20 to 24%, personal loans often in the 10 to 15% range, some auto loans can be above 7%, paying it off is a guaranteed return equal to whatever that interest rate is. And guaranteed returns like that do not exist anywhere else in finance. A guaranteed 20% return, which is what paying off a 20% credit card represents, is the best investment available to a person carrying credit card debt, not an index fund, not real estate, not anything. The credit card, pay it off. Beyond the math, and I think this part gets underweighted, the psychological relief of being debt-free is significant. There's a specific kind of low-grade financial anxiety that comes from carrying debt. The monthly reminder, the interest compounding against you, the feeling of running on this eternal treadmill. Eliminating that with a single decision is not nothing. It changes how you think, how you sleep, and how you make subsequent financial decisions. Pay it off. On the investing timeline question, once debt is handled, here's the framework I would use. I've gone over this before, and I want to be specific here because I think the conventional advice on this is genuinely wrong in a way that costs people real money. The conventional wisdom is that you should invest based on your age. The closer you are to retirement, the more conservative your allocation. 60 years old, you should be 60% in bonds. 40 years old, 40% in bonds. It's tidy, it's memorable, And it is, in my opinion, almost completely disconnected from what actually matters, which is not how old you are. It's when you need the money. So I call this the bucket framework, and it works as follows. Bucket 1, 0 to 2 years. Money you might need in the next 2 years does not belong in the stock market, period. It belongs in the vehicles we discussed above, high yield savings account, money market funds, short-term T-bills, safe, liquid, earning something reasonable, keeping pace with inflation, and available without you having to sell equities at whatever price the market happens to be on the day you need them. This is your operating capital. This is your sleep at night capital. Bucket 2, 2 to 10 years. Here's where it gets specific. Take the number of years until you need the money and multiply by 10. That gives you your equity percentage. So if you need the money in 5 years, you're 50% equities, 50% risk-free assets that we just discussed. 7 years out, 70% equities, 30% safer. The longer your runway, the more risk you can reasonably carry because time is the great smoothing mechanism in investing. Markets go down. They also come back up. Time is what lets you wait for the second part. For the equity portion of this bucket, here are the 3 funds I would consider and a quick word on each. VOO is Vanguard's S&P 500 ETF, tracks the 500 largest companies in America, expense ratio of 0.03%. This is the fund Warren Buffett told his trustee to put his wife's inheritance into. It owns Apple, Microsoft, Amazon, Nvidia, and roughly 496 other companies, and it does so for 3 cents on every dollar you invest. FXAIX. This is Fidelity's 500 index fund. Functionality identical to VOO in terms of what it owns, marginally lower expense ratio at 0.015%, and available commission-free at Fidelity. If your brokerage is Fidelity, this is your VOO equivalent. Pick one, there's no meaningful difference. Or VTI, Vanguard's Total Market ETF, owns essentially every publicly traded company in the US, not just the 500 largest, but mid-caps and small caps too. Slightly more diversified than VOO, slightly more exposure to smaller companies, almost identical in historical performance. But if you want the broadest possible US market exposure in a single fund, this is it. Any of these 3, low cost, broadly diversified, automatically rebalancing as the underlying companies change. You're not picking stocks, you're buying the entire market. Bucket 3, 10 years plus, 100% equities. VOO, VTI, FXAIX, pick one, stay in it, don't touch it, do not rebalance it towards bonds as you get older unless your actual timeline changes. This bucket is the engine, let it run. One important note on where to hold this. Since this money, this hypothetical $1 million, came to you outside of a traditional earned income context, it's not a paycheck, it's not a 401k contribution, it's living in a taxable brokerage account, which means I would be thoughtful about tax efficiency. The index funds like VOO and VTI are extraordinarily tax efficient. They have minimal turnover, minimal capital gains distributions, and qualified dividends taxed at favorable rates. This is not where I would be holding REITs, which are legally required to distribute most of their income and create an annual tax event you don't need, and it's not where I would be holding dividend funds. Keep it simple, keep it efficient. The brokerage account rewards boring investments. Number 3, consider investing in your primary residence. This is the one that surprises people, and I want to make the case carefully because I think it's genuinely underappreciated as a financial move. Once I've handled the cash position, paid off the debt, and invested according to my timeline buckets, if I had remaining funds that I didn't need for liquidity and wasn't planning to put into the market, I would put them directly into my primary residence. Here's why, and there are several reasons that stack nicely on top of each other. First, capital improvements add real value. Not all home improvements are created equal. Throwing money at a swimming pool or an elaborate landscaping project may give you joy, but tends not to give great return. The improvements that consistently add the most value to a home at sale are, in rough order, kitchen remodels, bathroom remodels, adding usable square footage, replacing major systems like HVAC or roof before they become problems, and curb appeal improvements that affect the first impression. A well-executed kitchen remodel returns somewhere between 60 and 80 cents of value per dollar spent at sale, and you get to use the kitchen in the meantime. A primary bathroom remodel returns similar numbers. These are not perfect investments, but they're real. Second, you're diversifying without paying someone else to do it. Everything in buckets 1 through 3 has been stocks, bonds, or cash equivalents. Your primary residence is real estate, a different asset class with different return drivers, different correlation to the stock market, and different tax treatment. You get diversification without paying a REIT expense ratio, without a fund manager, without any of the overhead that comes with financial real estate products. Third, and this is the one I really want you to understand, capital improvements raise your cost basis, and that matters enormously when you sell. Here's how it works. When you sell your primary residence, the IRS gives you a wonderful exclusion on capital gains. $250,000 for a single filer, $500,000 for married filing jointly. Gains above that threshold are taxable. But your gain is calculated as the sale price minus your cost basis. And your cost basis is not just what you paid for the house. It includes qualified capital improvements made during ownership. So if you bought your house for $400,000, spent $100,000 on a kitchen and bathroom renovation, your adjusted cost basis is now $500,000. When you sell for $800,000, your gain is $300,000, not $400,000. If you're married filing jointly and your exclusion is $500,000, you owe zero in capital gains tax on that sale. Without the renovation, you might have owed taxes on $50,000 of gains above the exclusion. So you have improved your tax position. You have improved your home. You have diversified your assets, and you get to use the nicer bathroom every single morning until you move. The one caveat I'd add is obvious. This only makes sense if you don't need the liquidity. Home equity is not a liquid asset. You cannot call your kitchen at 2 a.m. and ask for $50,000 back. So if your bucket analysis from thing 2 says you need cash available, fund the buckets first. The renovation is for money that genuinely has a longer horizon and doesn't need to be accessible on demand. But if that description fits, if you have money that's truly long-term and you own your home, the combination of real return, tax efficiency, diversification benefit, and daily enjoyment is genuinely hard to beat with a financial product. So, in order, day 1, put it in a high-yield savings account or money market. Day 2, pay the debt and invest by your timeline. Day 3, consider whether some of what remains belongs in your kitchen. This week's episode is brought to you by Thrive Market. Quick story. My wife and I got back from 2 months in Sedona, Arizona, where takeout was a block away and the grocery store was 11. We went there convinced we hated cooking. Turns out, no, we loved cooking. We hated going to the store. I live in rural Vermont. The grocery store here is, for a raging introvert, a mild form of psychological warfare. The lighting, the lines, the neighbor who wants to talk about the weather for 16 minutes while I hold a bag of wilting arugula. Thrive Market solved this for us in one sentence. High quality, pre-vetted ingredients delivered to our door. No DoorDash nonsense charging a premium for soggy fries and day-old burgers. Real ingredients we actually wanted to cook with. And the math adds up. $5 a month. And I treat it like I do any recurring subscription. Either it pays for itself or I cut it. It paid for itself in the first order through member pricing alone. Up to 30% off retail, no delivery fees, no service charges. And best part, every paid membership sponsors a free one for a family in need, a teacher, a first responder, or a veteran through Thrive Gives. that $5 is doing more than one thing, and that will always be my favorite kind of $5. Go to thrivemarket.com/Tyler for $20 off your first 3 orders, plus a free $60 gift. That's thrivemarket.com/Tyler. This episode is brought to you by Copilot Money. I have a group chat with 4 of my closest friends from my finance days. Between us, decades of managing other people's money, multiple licenses, and an embarrassing amount of opinions about actively managed funds. These are not people who download budgeting apps. These are people who tend to mock budgeting apps. And yet, every single one of them uses Copilot Money. The group text now contains, between bond market commentary and Bills game updates, sincere love letters to a finance app. One texted last week, "I finally feel like my financial life is in one place." That's from a guy who manages 8-figure portfolios. Here's why people who actually know money land here. It tracks spending, net worth, investments, savings goals, and budgets in one dashboard. And it's beautiful to look at, which shouldn't matter, but does when you're building a habit. It auto-categorizes transactions, it tracks subscriptions, so you'll finally find the streaming service you forgot about and the gym membership you've been emotionally lying to yourself about since February. It works across iPhone, iPad, Mac, and web. And, best part, they don't sell your data. It's the only personal finance app to win an Apple Editor's Choice Award, an Apple Design Awards finalist, and it has 4.8 stars from over 28,000 reviews. So go to try.copilot.money/Tyler, use code Tyler2, that's Tyler and the number 2, for 2 free months. That's try.copilot.money/Tyler. Section 2. 3 things I would definitely not do. Number 1, and this should be familiar to anyone who's listened to the podcast for a while, I would not let anyone manage it immediately. Let me tell you something that I know from very personal experience. The moment you have $1 million, or are on a list that suggests you might, the phone calls start. And they're not calls from people who have found some revolutionary approach to investing. They're calls from people who have found your name on a database and have been trained to open with the phrase, "Hello, I've identified some potential tax inefficiencies in your current portfolio," as though they're a doctor who has spotted something on an X-ray. I know this because I get these calls. And I will confess to you that sometimes I can't help myself and I play along. Not out of cruelty, but out of genuine professional curiosity about what they're going to say. I let the 22-year-old from the major brokerage walk me through the inefficiencies in my account that they haven't yet looked at. And every single time, after 15 minutes of patient listening, the inefficiencies turn out to be, oh, they haven't found anything. What they have found is my name on a list and a script that sounds like a diagnosis. Here's the actual diagnosis. A 1% AUM fee on $1 million is $10,000 per year. Every year, regardless of performance, compounded over 20 years. That fee, just the fee, not counting any underperformance relative to an index, costs you somewhere between $200,000 to $300,000 in foregone compounding. For someone doing what I described in Section 1, money market, timeline-based investing, 3 low-cost index funds. Now, I want to be fair here. There are circumstances that I've gone over before where working with a financial advisor makes genuine sense. Complex tax situations, estate planning, business ownership, genuine need for behavioral guardrails. I believe in fee-only fiduciary advisors who charge a flat fee or hourly rate rather than a percentage of assets. If you need one, find one who is legally obligated to act in your best interest and who charges you like a professional rather than a percentage. But in the immediate aftermath of coming into $1 million, while it is safely earning 4% in a money market fund, while you are getting oriented, do not hand it to anyone. The money is fine where it is, and it will be for a year. You're not losing anything by taking 60 days to think. The only people who benefit from urgency in this scenario are the people creating the urgency. Let the calls go to voicemail. The inefficiencies will still be there when you're ready to make a decision. Number 2, I would not dollar cost average into the market or try to time the market. This is one where I want to be honest that there is a right answer and a human answer, and they're not always the same answer, and both are worth understanding. The right answer mathematically is to invest a lump sum immediately according to your timeline buckets. The market rises in roughly 73 to 75% of all calendar years. If you have a lump sum to invest and you spread it over 12 months, you are statistically likely to be buying at progressively higher prices in 7 out of 10 scenarios. Vanguard's research puts the average underperformance of 12-month dollar cost averaging versus lump sum at roughly 2.3%. On $1 million, that's $23,000 in expected foregone returns for the psychological comfort of spreading the risk. Now, the human answer is that most people cannot emotionally execute a lump sum investment, especially of $1 million, because they're terrified of the scenario where they go all in on a Monday and the market drops 15% on a Wednesday. That fear is understandable. It is also statistically an expensive way to feel better. Here's what I would tell you. Go back to the bucket framework. If your short-term needs are covered in bucket 1, and your medium-term needs are balanced in bucket 2, then a market decline immediately after you invest your long-term bucket is not remotely catastrophic. It is a fluctuation in money you have already decided you don't need for a decade. So you ride it out because you built the system specifically to allow you to ride it out without needing to sell. The bucket framework is not just an investment strategy. It is the behavioral infrastructure that makes lump sum investing psychologically executable. When you know the money you need tomorrow is in cash, the money you need in 5 years is balanced, and the money in the market is genuinely long-term, the short-term volatility stops feeling like a crisis and starts feeling like the cost of admission to long-term returns. So I would invest according to my timeline immediately in the 3 funds described above, and I would not wait for a better entry point. There is never a moment when the financial news cycle says, hey, now is a great time to invest. The best time to invest was always yesterday. The second best time is today. Number 3, I would not immediately buy depreciating assets. Note the immediately here. This is perhaps the most counterintuitive thing I'll say today. And I want to make the case carefully because I think it reframes how most people think about what money actually does. There's an old phrase, make your money work for you. The phrase gets repeated so often it has lost most of its meaning. Let me try to give it back some. If you make $100,000 a year, spend $100,000 a year, and invest nothing, you're working for money. Forever. The day you stop working is the day the income stops. Your labor is the only engine. But if you invest even a small portion of that income into assets, stocks, bonds, real estate, anything expected to appreciate in value or produce cash flow, you begin building a principal that generates its own return. Over time, that principal grows to the point where the return on the principal begins to rival and eventually exceed the return on your labor. That is the moment the equation flips. That is when money works for you. $1 million invested at a long-term historical average of 7% returns $70,000 per year. In the first year, without your doing anything, without your going to work, without your producing anything at all except the discipline to leave the principal alone. But here's the critical insight. That only works the way we'll want it to if you leave the principal alone. So if you come into $1 million and immediately buy a $60,000 car, you now have $940,000 working for you. At 7%, that's $65,800, not $70,000. That car cost you $4,200 in annual investment return every year forever in addition to the $60,000 you spent. And the car is worth $42,000 a few years later. But if you wait, if you put the $1 million to work and leave it alone for a few years. At 7% compounding, after 2 years, you'd have roughly 1.145 million. 7% on the 1.145 million is roughly $80,000 per year. The interest alone in year 3 is enough to buy that car. The principal remains untouched. You got the car, you didn't touch the million, you spent the interest on the million. That is a fundamentally different relationship with money than most people have, and it is available to anyone with that kind of money with the patience to wait a couple years. So my rule, stated simply, now that I am beyond this level, $1 million is a base investment principle, and I will never touch it. I will let it compound, and in 2 years, when the interest has accumulated, I'll buy whatever the heck I want from the interest, not from the principal. That principal I treat as sacred. The interest can be mine to spend on things that I want that might be personal finance sacrilege, like a Sierra Denali. Can't help myself, I said what I said. Once you have a base of $1 million and you genuinely leave it alone, you'd be amazed how many things become effectively free. The car, the vacation, the renovation above and beyond what makes financial sense. All of it becomes accessible without spending the principal, because the principal is large enough that its returns begin to fund a real life. But none of that works if you spend the million on a truck the day you get it. Section 3. 3 behaviors I would watch for. Behavior 1. Mistaking volatility for loss. This one will come for you, I promise. No matter how prepared you feel, no matter how well you understand the data, there will be a moment, probably a Tuesday, because bad market days always feel like they happen on Tuesdays, when you open your brokerage account and the number is meaningfully lower than it was last week, and your stomach will do something specific and unpleasant that your rational mind will be unable to fully override. And in that moment, I want you to remember this always. A paper loss is not a loss. It is a fluctuation. You have not lost money until you sell. Until you hit the sell button and convert a fluctuation into a realized loss, it only exists in magical stockland as a smaller piece of the same pie, not as a smaller pie. I use the house analogy because I think it makes this visceral in the right way. When the Zillow estimate on your house drops by $50,000 in a slow real estate market, you have not lost $50,000. You own the same house, the same walls, the same roof, the same square footage. The market's current opinion of its value has changed. The house has not. And unless you are selling the house this week, the market's current opinion is almost entirely irrelevant to your financial life. The stock market works in the exact same way. When the S&P 500 drops 14% in the third quarter, which is roughly the average intra-year decline in a typical year, and the market still finishes positive in 3 quarters of those years, you have not lost 14% of your wealth. You own the same fractional shares of the same 500 companies or total market. Their earnings, their products, their customers, their competitive positions, none of that changed because the market had a bad month. The price changed, the asset did not. The investor who sells during the decline turns a fluctuation into a permanent loss. The investor who holds owns the recovery that almost always follows. As we've gone over countless times, Delbar's annual research consistently shows the average equity fund investor underperforms the average equity fund by 3 to 4 percentage points per year. That gap is not explained by bad fund selection. It is explained by selling during downturns and buying during recoveries, the precise opposite of what the math requires. So I would watch out for the moment my stomach does the thing, and I would not touch anything. Behavior 2. Mistaking complexity for competence. Right around the time you have $1 million, a specific and very expensive thing happens. people start suggesting that you need more sophisticated investments. The index fund is for regular people, the implication goes. You are now a person of means. You should be in private credit, structured notes, alternative investments, hedge fund strategies, real assets, infrastructure plays. The guy on the phone from the brokerage has a presentation. It's nice, it's laminated, it's obnoxious. It is 47 slides long and it has a lot of charts that go up and to the right. I want you to hold on to something very simple. There has never been a peer-reviewed study, not one, in 50 years of financial research, showing that the average investor who moves from low-cost index funds to complex alternative strategies improves their after-fee, after-tax returns. Not one. What the research does show, consistently, is that complexity increases costs, reduces transparency, decreases liquidity, and introduces risks that are genuinely difficult to evaluate without specialized expertise. Burton Malkiel, who I spoke with at length in the recording that I then managed to delete, which is a thing that happened and I have finally accepted, is 93 years old. He has spent his entire career as both a practitioner and an academic. He has sat on the Vanguard board. He has seen every investment product the financial industry has invented since 1973 and probably before that. And his conclusion, stated clearly and without apology in 13 editions of the book Random Walk Down Wall Street, is unequivocally, buy low-cost index funds, pay as little as possible in fees, and ignore the rest. At 93, after seeing everything, the answer is still VOO or VTI for risk on, money market or HYSA for risk off. And if you want real estate diversification, renovate your bathroom. That's it. That's your whole portfolio. The complexity is the trap. The simplicity is the strategy. Active management, on average, underperforms the index by approximately the amount of its fees every year, which means the sophistication you're paying for is, in aggregate, a fee you are paying to do worse than the thing that costs you almost nothing. And the financial industry has made trillions from that trade. You do not have to participate in it. Behavior 3, keeping up with other millionaires. This one's the most personal, and I want to get specific about it because I think the generic "don't keep up with the Joneses" advice has been repeated so many times it's almost lost its meaning and has stopped landing. Here's what I have observed. When people come into meaningful money through inheritance, a business sale, a liquidity event, whatever the mechanism, there's a specific psychological pressure that arrives with it. A sense that you are now supposed to live differently, that your surroundings, your car, your wardrobe, your vacation choices should somehow signal the change in your financial position. The money should be visible. I want to tell you about my grandfather. My grandfather and I did not know each other particularly well, but what I know about him is that when he came into money, after working for it, building it, earning it over decades, he did not change. He drove the oldest, most reliable car he could find, not because he couldn't afford something newer, because he had decided somewhere along the way that the car was a tool for getting from one place to another, and that the person he was had nothing to do with what the tool looked like. My father's the same way. He drives a trusty Subaru, not because he's making a statement, because it's Vermont, and that car is phenomenal in Vermont snow, and he's not trying to prove anything to anybody. He is, in the most genuine sense, immune to the social pressure that most people pay enormous amounts of money to satisfy. I have tried to internalize this, with varying degrees of success, I'll be honest, because I'm not immune to wanting things that look good, but I have come to believe that the Bill Belichick approach to wealth, as I so lovingly call it, and use that comparison with full awareness that it's slightly absurd, but I think it's correct, is the right one. Bill Belichick has spent decades making himself look as unbothered by status as it is possible for a person to look. The hoodie, the attitude, the complete indifference to what anyone thinks. And he won more than almost anyone. The danger of having $1 million is not that you'll spend it. The danger is that you'll spend it on things you don't actually want because you've internalized a story about what a person with $1 million is supposed to want. The boat you'll use never, the house that's bigger than the life inside of it, the car that communicates a net worth rather than gets you through Vermont in the snow. For me, having money has always meant one thing above everything else: freedom. Specifically, the freedom to not have a boss. I do not do well with people telling me what to do. Ask anyone who's known me for more than 15 minutes. And the accumulation of financial independence has meant that I get to run my company. I get to run my days, and I get to run my life according to my own values without having to explain or justify any of it to anyone. I might as well be retired in terms of how I spend my time. That freedom is what the money bought me. Not a car, not a watch, not anything you could see from the outside. In fact, the only watch I wear is still a Timex that they sent me when I did a promo video for them back when I had 3,000 followers on TikTok. So shout out to Timex. That was the coolest thing that's ever happened to me, and the watch, beautiful, still works. Now, what does freedom mean to you? Not in the abstract. Specifically, what would you do differently tomorrow if the million landed tonight? Whatever that answer is, that is what the money is for. Not the visible signals, not the comparison, but the actual answer to that actual question. And here's the last thing I want to leave you with. Once you have the financial foundation in place, the money market, the invested principal, the debt cleared, and the bucket framework running, the $1 million doesn't change who you are. It just gives you more room to be exactly who you already are, without as much financial static getting in the way. My grandfather understood this. My father understands this. I'm working on understanding this, but I am doing better. The more I write about it, the more I think about it, the more I talk about it. The goal was never to look like a millionaire. The goal was to have the freedom to stop working for somebody else. In closing, let me bring the entire episode together. The 3 things I would do. Day 1, high yield savings account or money market. Don't let $1 million sit in a checking account earning nothing while you think. 3% on $1 million is $30,000 per year. Don't give that away. Day 2, pay off any debt above 7%. A guaranteed return beats any investment, and then invest what remains according to when you need it, not how old you are. Bucket 1 for the next 2 years, bucket 2 for 2 to 10, bucket 3 for the long run, all in low-cost index funds through a tax-efficient brokerage account. Day 3, consider whether some of what remains belongs in your primary residence, the capital improvements, the cost basis, the diversification, the nicer bathroom, in that order. 3 things I would not do. I would not hand it to anyone who called with urgency, because the urgency is theirs, not yours. I would not dollar cost average, because the math says invest it according to your timeline immediately. And I would not buy a depreciating asset with the principal. I would wait until the interest paid for it, and then the principal is still whole. And the 3 behaviors I would watch for: mistaking volatility for loss, as a paper loss is not a loss, and you'll only lose if you sell. Mistaking complexity for competence, VOO, VTI, money market, renovate the bathroom, full stop. And keeping up with an idea of what a millionaire is supposed to look like, rather than asking what you actually want your one and only life to feel like. The $1 million is not the destination. It is your financial infrastructure. The life is still and always will be yours to design. As always, hope this gives you something to think about in the week ahead. Thanks for tuning in to your Money Guide on the Side. If you enjoyed today's episode, be sure to visit my website at tylergardner.com for even more helpful resources and insights. And if you are interested in receiving some quick and actionable guidance each week, don't forget to sign up for my weekly newsletter, where each Sunday I share 3 actionable financial ideas to help you take control of your money and investments. You can find the sign-up link on my website, tylergardner.com, or on any of my socials at socialcapofficial. Until next time, I'm Tyler Gardner, your money guide on the side, and I truly hope this episode got you one step closer to where you need to be.